Hello and welcome to United Asset Strategy's quarterly investment update. For today, we want to accomplish two things. One is to give a review of the first quarter, and then secondly, to give an outlook for what we're seeing in the market in terms of opportunities and risks and portfolio positioning. With me today to do that is Matt DeLorenzo, our Chief Investment Officer, and Jiorden Sanchez, one of our Senior Portfolio Managers. My name's Tom Healy. I'm our Chief Portfolio Strategist. So for the first quarter, we saw markets broadly up, continuing a trend that we saw actually in the fourth quarter, where both bonds and stocks increased during the quarter. The primary driver for both was the perception that the Fed was successfully reducing inflation while coming towards the end of the rate hike cycle and doing so with a soft landing for the economy. Now, as we go through here, you'll see that we have a view that may not be exactly the same as the market perception. Nonetheless, it did result in upward movement in markets, with the stock market up 7% in the first quarter and the bond market up 3%. This followed the fourth quarter, where stocks were also up a little more than 7% and bonds were up a little less than 2%. Now, while stocks were up 7% in each quarter, there was definitely a major change in leadership, a rotation, as we would say, within the equity market. So in order to discuss the nuances for the quarter, I'm going to turn it to Jiorden and Matt to give us updates.
Right, so at least so far, 1Q represents a welcomed reversal of some of the pressures we've seen in 2022. While the primary driver over both periods was probably a direction of interest rates and the inverse relation of valuation multiples, that's really where the similarities end. So for example, last year was very much about the concerns about inflation, the Fed's reaction to that concern, and the need to increase interest rates, and the subsequent inverse relationship with PE multiples, which caused PE multiples to contract about 20% or so. There's really no contributory factor from earnings, so that contraction multiple was really the driving force of what drove stocks down last year. Now, so far this year, you've seen a reversal of those trends. So for example, inflation-related concerns have begun to subside a bit. The Fed has taken a bit more of a measured message as it relates to interest rates. You've seen interest rates pull back a little bit, and now you're seeing valuation multiples expand. So far this year, PE multiples are up about 8 percentage points, and that accounts for the entire increase in stock prices we've seen this year. Another interesting sort of difference is sort of where you've been seeing the strength and weaknesses. So as you would expect in a market driven by valuation multiples, those subsets of the markets with the higher multiples were the most sensitive to changes in rates. So last year, you saw high multiple growth stocks significantly underperform lower multiple valuation stocks. That trend has reversed this year, with growth stocks driving the market higher, at least in the first quarter. Similarly, some of those sectors that lean heavily on some of those big tech secular growth names, like consumer discretionary, communication services, and technology, were the drivers of downside to the market last year. But this year, they've been the drivers of some of the strength we've seen in the market. So again, a very welcome reversal in some of the pressures we've seen in the market for the year, and hopefully some of those trends continue.
Thanks, Jiorden. Yeah, and on the fixed income side, we've had some volatility throughout Q1, but in general, bond prices have been up as interest rates declined. But entering January, the bond market really built on the rally that had kind of started to develop in late October, early November. And this was, as Tom had mentioned before, really on the back of the market getting comfortable with the idea that the Fed was very close to hitting its terminal rate and really the end of its tightening cycle. So that really helped lift the bond market in Q1 and continue on that rally that we had seen in late 2022. That actually reversed itself as we moved into February, as we saw some inflationary reads come in a little bit higher than expected. And we also saw some employment reports that were stronger than the market expected. So the market took that to mean that the Fed was perhaps a little bit further off getting to the end of their tightening cycle than previously believed. So that really reversed a lot of the strength that we saw in January. As we moved into March, we saw some turmoil in the banking sector and issues with Silicon Valley Bank, Signature Bank, to name a few. And that really changed the market's view of the Fed in a slightly different way, in that the market began to feel that the Fed was going to be unable to continue hiking and more likely to cut interest rates due to an unfolding economic scenario as opposed to an inflationary concern. So we left March with interest rates a little bit lower, credit spreads a little bit wider because of what was going on there.
Great. Well, hopefully that gives you a good sense of what we had seen in the first quarter. Now going forward, we'll get a better sense of what we're seeing on a go-forward basis. One thing I would mention to Matt's point about the labor market, because that is important to the Fed, is we're starting to see some crack in the labor market. And by that I say, if you look at the last 3 weeks in particular, U.S. Jobless claims are higher than anticipated. And over the last few months, we've seen the number of job openings decline from a little over 12 million down to 9.5 million. You're seeing more layoffs being announced. So there is some concern about labor markets, although the Fed would welcome that. That's part of what they're trying to do. But the key will be, how does the consumer hold up? And that's been a critical part of keeping the economy from falling into that recessionary area. But looking forward, there are a lot of risks and opportunities that we're seeing out there. And I'm going to turn it back to Matt and Jiorden to discuss more.
Thanks, Tom. Yes, so given the recent cracks in the labor market and a little bit of softening there, combined with some inflation reads coming in a little bit light recently, the market has become very optimistic that the Fed is going to quickly shift into cutting rates mode as we move further into the year. So a big risk that we're seeing is that there's actually a disconnect between what the market is expecting and hoping for, and then what the Fed is actually out there saying. So Fed communications have indicated to us that basically they are more likely than not to hike one additional time and then keep interest rates on hold for the remainder of the year before potentially cutting in 2024, where the market is actually anticipating anywhere between 2 to 4 cuts in 2023. So that little bit of a disconnect can set up for some disappointment and at the very least some interest rate volatility. And we think that can have some potentially negative impacts on credit spreads. So for us, that translates into wanting to be up in quality. And we're also overweight longer term bonds, which we think could benefit more than shorter term in this scenario.
Yeah, so from an equity perspective, you can argue that the equity markets have been a bit more focused, especially over the last year or so, on the direction of rates and the immediate impact on valuations. But you commonly hear the term that monetary policy operates with a long and variable lag as it relates to the economy. And so we do think over time, some of that focus on valuation may shift towards, the earnings outlook. So in other words, the rapid rise in interest rates and the lagged impact on the economy and company profits. So as it relates to the economy and earnings, there are really 3 things we're monitoring. So one is earnings season. We alluded to on the last video how we were entering 4Q earnings season, and it was seasonally important because it was the first time a good chunk of corporate America would start providing guidance and an outlook on corporate profits for the full year, 2023. 4Q earnings season has come and gone, and so far earnings have kind of held in there. Next 12-month earnings are only down about 1% or so from the start of the year, and that's not what you would expect if it was in an environment where corporate America was really relaying some significant pressures as it relates to a recession. Separately, we are now starting to enter 1Q earnings season. And so far, they've also kind of proven to be a bit more resilient. So far, 80% of companies, a little more than 80% of companies, are beating expectations. That compares to about 70% or so historically. So more companies are beating. They're also beating by a wider margin. Historically, they've beaten by about 5% or so. So far in 1Q, companies have beaten by about 7%. And so corporate earnings have remained resilient, and given that, I'd move to my next point. As a result of strong earnings so far, you've seen elements of the stock market act in a risk-on manner. So one way to look at that is looking at cyclical sectors. Cyclical sectors, which are reliant on a strong economy to produce results, have actually outperformed defensive sectors, which tend to be a bit more resilient to the economy. They've outperformed by about 7 percentage points or so. And interestingly, lower quality stocks, those that generally do not produce as much cash flow and rely a little more on the fixed income market to finance their growth, have actually outperformed higher quality businesses. And so those two subsets would suggest there are elements of the equity market that are starting to price in a bit more of a risk-on scenario. And that sort of makes sense given the strong earnings we've seen so far. The last point I would make is on valuations. Valuations also don't seem to be kind of outlining a dire concern as it relates to earnings. So I alluded to how earnings multiples have been up so far this year. They're currently at about 18 times or so. That implies an earnings yield of about 5.5%. Now, really quickly, when you compare that to the Treasury yield, which is commonly referred to as the risk-free rate, it's only about a 200 bip spread to the 10-year Treasury. Historically, that number has been closer to 300 bips. So in other words, it's tighter than usual, which would suggest that the market's pricing in a little less risk to earnings than you would expect in an environment, once again, that was very focused on recessionary risk. So all those items taken together kind of suggest, at least so far, the economy and corporate America has been able to kind of, push off any sort of recession-related pressures. But that's not to say it's not something we're continuing to focus on as we manage portfolios actively on your behalf. So, point one would be, obviously, that we've talked to how the Fed operates with a long and variable lag. That does suggest that earnings is something we should still monitor as a risk source. And so we have, in your portfolios, tilted a bit more towards companies that have resilient earnings profiles. These are usually larger cap companies. These are usually more, quote, higher quality companies. These are usually a bit more defensive sectors. Those areas of the market, should we enter a period where earnings are at risk, should hold their value a bit more. Separately, we've also, for some strategies, have some risk management in place as it relates to positions in cash, gold, or hedges. As it relates to cash specifically, for those subsets of strategies that have a good cash allocation, a decent sized cash allocation, we've put some of those clients in higher yielding money markets as we wait for opportunities. And then lastly, we have been opportunistic. This is always balancing risk and reward in the long run to drive returns. And so, another way of sort of managing earnings risk is investing in some of those secular growth companies that could grow through a tough earnings environment. Given the tough market we saw last year, a lot of those stocks are opportunistically trading cheap right now. And so we've added exposure there as well. But broadly speaking, the positioning is really balanced and mixed. We're aiming to keep clients invested for the long term, but cognizant of some of the macro-related risks in the near term that we have to navigate through.
Great. Hopefully that gives everyone a really good picture of a lot of the risks and opportunities that we're seeing out there in equity and fixed income markets. One last risk I'll leave you with is the debt ceiling. Obviously, that's going to be front and center. In the news, Speaker McCarthy sort of got the process going with a speech to the New York Stock Exchange in which he outlined the House GOP plan to raise the debt ceiling along with budget cuts. If he can get the 218 votes he needs, that'll then go to the Senate, where the Democrats in the Senate can then put together a bill, and then the negotiation process starts in earnest. Right now, the X date, so to speak, where the Treasury Department will exhaust its extraordinary measures is considered the summer. Whether it's early or later in the summer will depend on how the tax receipts in April come in, so we're watching that very closely. But again, that's just something, one of the many risks that we're looking at as it relates to the opportunities that they present as well. So before we sign off, a couple of admin things. One is, we said last quarter, and we'll remind you that the TD and Schwab integration continues. One thing that we would remind you is that we've had long-standing relationships with both custodians, and it will not affect your relationship with United Asset Strategies. As it progresses, we'll have more communications from our client experience team, and if you have any specific questions, your relationship team stands ready to answer those. And then lastly, the team is very proud to announce yet again that we were named to Forbes' Best in State Advisor list for New York State, coming in at number 29 in the entire state. So we're very happy about that and pleased to report that to our clients. With that, we wish you all a great spring, and we'll see you again in the summer.